Hello, this is the introduction to Lesson 3 in Chapter 3. I start here with the map of the chapter. And this chapter is about the four sectors of the economy: households, firms, government, and the foreign sector. In Chapter 1 we had the circular flow diagram that only had two of these sectors, households and firms. So this adds the last two, governments and the foreign sector, and in each case there's interesting stuff to look at here. The chapter is very readable, so except for a few things that I'd like to point out, it's all pretty simple and readable. The first is households. They maximize utility, or attempt to maximize utility, which means basically their satisfaction levels. The impressive part of the business of households in the past, I don't know, 50 years or so, is the changing composition. Specifically, the number of people, of households with one person in them. This was very, very rare 50 years ago, and now it's very, very common. The second is the number of families with one parent. One-parent households used to be very, very rare before, and now they're very, very common. These are both enormous changes. Households get their income from the sale of the resources that they own and sell in the factor markets. If you look at the circular flow again in Chapter 1, you can see this. Firms are maximizers of profit, we assume. The chapter talks about the history of the firm, and they talk about household production, which almost disappeared for a while and now seems to be back. It turns out that I'm in my household and I'm working, so I'm doing household production. There's a man named Ronald Coase who won a Nobel Prize in economics for talking about how firms behave, why they get as big as they are, and so forth. I have a link to this in this page as well. It's very interesting if you have the time to read it. The types of business organizations, there are three: proprietorships, partnerships, and corporations. Each have advantages and disadvantages. For instance, corporations have limited liability, they have access to capital markets, but they're difficult to organize, they're costly to organize, and there's a separation of ownership and control. The owners are the shareholders, but the people who control these corporations are the managers. And oftentimes their opinions about what needs doing diverge. That is, managers oftentimes want Learjets to the Super Bowl, but the owners feel that that takes profits out of their pockets, and so the owners and the managers are oftentimes at variance in their goals. Proprietorships are easy to organize, they have direct incentives, but there are disadvantages. One is there's unlimited liability. There's no difference between the liabilities of the business and your personal liability. So if your business loses money, they can come and take your personal stuff, your couch, for instance. Anyway, if you need to know the types of business organizations, the advantages and disadvantages of each. Now, government. What does government maximize? Depends on which government. Oftentimes the politicians attempt to maximize votes and revenues, that is, contributions to their campaigns. People who work in government offices oftentimes want to maximize the area that they control to make their section bigger. It gives them more say, more money, and so forth. There is not such a thing as the government. There are thousands of different government agencies, and they oftentimes have different goals that oppose other government agencies. The characteristics of government is governments decide things collectively. So once a decision is made, the government has the power to coerce, that is, to force everyone to pay. If you doubt this, just wait until April the 15th. What does the government do? Well, these here are the roles of the government. The government, the first one, is to provide rules of the game. That is, the basic foundations of law and courts and contract enforcement, and more importantly, the rights, protecting people and their property. Now, all of these other ones, promoting competition, regulating business, redistributing income, stabilizing the economy, dealing with public goods and externalities, all of these are a response to something called market failure. That is, if the markets are left to their own devices, they will fail in these areas, and the government needs to step in and fix the failure, to reduce the failure. But when we look at these, there are compelling arguments that suggest that in addition to market failure, there is government failure. So when we talk about problems that exist, sometimes we have to balance the risk of, or the damage that might happen because of market failure against the damage that might happen if the government steps in and attempts to resolve the problem but ends up failing itself. So anyway, two of these, public goods and externalities, deserve additional attention, and I have made videos for both of these. So this public goods video, if you watch it, you get... All right, it's time to talk about public goods. You get bad video and good music. Anyway, the videos might be helpful. There's another one on externalities here. There's an article online about externalities to help you read it, and then there's a video by Richard McKenzie, the guy at UCI's Graduate School of Business, on this as well. So there are plenty of resources. How does the government, the size of government's interesting, has grown enormously in the 20th century. How do governments finance themselves? They finance themselves with income taxes for the federal government. States are normally sales taxes, although sometimes income taxes as well, and local governments' property taxes are the primary source of their revenues. There are lots of different ways of looking at taxes. One is the ability to pay versus the benefits received principle of taxation. Both of these are discussed in the book. And then progressive, regressive, and proportional. Progressive, in all cases, you have to count them as percentage of one's income. So what this means is that with a, for instance, progressive tax, an example is the income tax, higher income types pay a larger percentage of their income. It's not the dollar amount that matters, it's the percentage of their income that matters. And regressive tax, higher income types pay a smaller percentage of their income. Proportional, everybody pays the same tax rate, that is the same percentage of their income. Examples of proportional taxes are flat taxes. These have become popular in the countries after the fall of the Soviet Union. Regressive taxes, an example is Social Security. The tax is 15% roughly from zero to about $100,000, and after $100,000 the tax rate is zero on each additional dollar. This brings up the issue of marginal tax rates. And marginal tax rates are the tax on the last dollar earned. This is an example of our tax system. This is for single in the year 2010. From 0 to 8,300, you pay 10 cents on each of these dollars. From $8,375 to 34,000, you pay 15 cents on each of these dollars. Then, above 34,000 to 82, you pay 25 cents. 28 cents on each of these dollars, 33 cents on each of these dollars, and 35 on everything above 373 if you are single. These are going up probably. But anyway, in this case, this is the progressive income tax and marginal tax rates. These are the marginal tax rates. The tax on the last dollar earned go up as income increases. We go back here, and then the Laffer curve talks about the relationship between taxes and incentives. It is possible to kill all incentives to work or do anything visible to the government if the taxes are high enough. The last section has to do with the foreign sector. And in the foreign sector we ask, why do people trade? The answer is obvious: it makes people wealthier. That's why the enormous amount of trade goes on in the world. There are trade restrictions. Countries routinely attempt to restrict trade to benefit certain groups inside those countries. These restrictions take the form of tariffs, which are taxes technically on exports or imports, and also non-tariff barriers like quotas or restrictions on foreign exchange and so forth. International finance, we look at Foreign exchange, those are the currencies. It's not Helga from Norway who comes here for a year. These are the currencies themselves that are used in the foreign trade. Foreign exchange markets, there's something like $2 trillion a day of foreign currencies traded one for the other. These foreign exchange markets are enormous, and the foreign exchange rates come out of these markets. The dollar is currently, the euro is $1.39 per euro. That rate is determined by supply and demand in these markets. Anyway, the balance of payments is there. You can look at the balance of the official books and so forth. Anyway, I think it's a nice chapter. I think you'll like it. It's very readable. The points of emphasis are the types of business organization advantages and disadvantages, the roles of government, particularly with regard to public goods and externalities, types of taxes, progressive, regressive, what is a marginal tax rate, and then there are a whole bunch of terms as well. So that's it. That's it. Thanks.